Under the accrual basis, companies record transactions that change a company's financial statements in the periods in which the events occur. Although GAAP requires the accrual basis of accounting, most individuals and some small businesses use the cash basis of accounting, which is an alternative to the accrual basis. Under the cash basis, companies record revenue when they receive cash and record an expense when cash is paid. Under accrual basis accounting, transactions are recorded in the periods in which the events occur. So companies record revenues in the period in which they perform services or deliver products, rather than when they receive cash. It also requires expenses to be recorded when they are incurred, rather than when paid. Under cash basis accounting, companies record revenue when they receive cash and record an expense when cash is paid. Companies record revenue when the cash is received from customers and record expenses like salaries and wages when cash is paid to employees. The cash basis seems appealing due to its simplicity, but it often produces misleading financial statements. As a result, it does not match expenses with revenues. So cash basis accounting is not in accordance with generally accepted accounting principles or GAAP. It can be difficult to determine when to report both revenues and expenses. The revenue and expense recognition principles help in this task. When a company agrees to perform a service or sell a product to a customer, it has a performance obligation. When the company meets this performance obligation, it recognizes revenue. The revenue recognition principle requires that companies recognize revenue in the accounting period in which the performance obligation is satisfied. This is when either the services have been performed or the products have been delivered to customers. Let's assume that Dave's Dry Cleaning cleans clothing on June 30th, but customers do not pick up and pay for their clothes until the first week of July. This company should record revenue in June when it performed the service, rather than in July when it received the cash. On June 30th, they would report a receivable on its balance sheet and revenue in the income statement for the service performed. Under the expense recognition principle, the expenses incurred in generating revenue must be reported in the same period as the revenue. This is also called the matching principle. In the dry cleaning example, the company should report the salary expense incurred in performing the June 30th cleaning service in the same period in which it recognizes the revenue. If the company does not pay the salary incurred on June 30th until July, it will report salaries payable on its June 30th balance sheet and an expense in the income statement. To summarize, under cash basis accounting, revenues are recorded when cash is received, and expenses are recorded when cash is paid. Whereas under accrual basis accounting, revenues are recorded when earned, again when the services have been performed or the goods have been delivered, and expenses are recorded when incurred.